let this sink in for a little bit. Commercial real estate is headed for a meltdown on a scale that we have never seen. This is going to be just like the global financial crisis of 2008 with real estate in the biggest bubble in history, bigger than then, plus commercial real estate, plus the stock markets. That didn't happen in 2008. That was residential real estate and mortgage-backed securities and derivatives meltdown. This is a far greater disaster.
Something massive is unfolding behind the scenes. Commercial real estate, once the bedrock of America's banking system, is quietly collapsing. Office towers are half empty, loans are defaulting, and banks are desperately hiding the damage behind accounting tricks. Mike Maloney calls it a slow-motion implosion, warning that this will be far worse than 2008, because it's not just housing this time, it's everything. Offices, retail, credit markets, and the regional banks that never fully recovered from the last crash. And Peter Schiff says the real consequence isn't just another bailout or recession, it's the end of confidence in the US dollar itself. Gold and silver, he argues, are already signaling what's coming next. If you own gold or silver, or plan to, this is the moment to pay attention.
First one is just the search term. This is from Polymarket. Breaking. Searches for help with mortgage surpass 2008 housing crisis. So this is, we're supposed to be having this great economy according to the government. Everything's peachy according to the stock markets. And people are searching for help with their mortgage greater than they were in 2008, the global financial crisis. This is insane. And this is honest data that anybody has access to. If you search for, Google searches for give car back are near all-time highs, and that's from Darth Powell. So this is another one, give car back. Then building permits have rolled over and are falling. And what you notice here, with the exception of this false flag right here, when they roll over, a recession is just behind. And here with the exception here, it's sort of, in 1998, it didn't really roll over that much. It just slid. But, it predicted the global financial crisis pretty well. But look at what's happening now. It's been rolling over since late 2021, early 2022. So we're headed for something that's probably not going to be very good. The case freight index. Now, the freight index, this is very important because if we've got this booming economy and we've got this booming stock market, it means that all those companies in the stock market should be building and selling more stuff that has to be shipped to somebody. If the freight index is falling, it means that, and it dropped 9.3% year over year in August, hitting its lowest level since 2020. This is really bad news. Late rent payments continue to tick up, and late rent payments are skyrocketing from Darth Powell. And they are. Look at that trajectory here. And this is, all in 2025, this turnaround. It was falling on the average, and then suddenly, this year, it just started to take off like a rocket. So we're in some trouble. This is used cars. So this is CarMax. So this is what used car stocks are doing. Look at that plummet, and this was based on sales and earnings. The stock plummeted, so used cars are in trouble. Turning to the stock market, Swing Trader says this short will be more rewarding than the COVID crash or the global financial short. Well, I'm not shorting anything. There's a potential for some serious losses when you short or some big gains. Feel free to do whatever you want. I don't give financial advice. But look at this trend line. There's 1, 2, 3, 4 hits establishing a very, very solid trend line. And look at where we are. We're up out of the top of it, meaning that a huge crash can happen. The correction can be enormous, and we are in dangerous area. the S&P 500 versus job openings. Look at the great correlation that they had in the past. When one is going up, the other one is going up until the beginning of the end of 22, beginning of 23. So this divergence is really bad, and it's been going on for several years now. And so something is going to break, and when it does, I believe it's going to be horrific. Spencer Hakamian says, AI boom versus .com bubble, scary. Now, there's no time scale on here, but the time scale is here. This is 4 years, 98 to 2001. This is 23 until now, which is only 2 years, but you'll notice that the line here is not done yet. So they're probably on the same time scale. Now, I wish that he could have shifted this, made this go up to a scale of 8,000, and then shifted this by this one notch, because what you've got here is a factor of 5, and this is also a factor of 5, and it would be great if he could have lined these two lines up so that they start at the same point, because you'll see that today's climb is much steeper than going into the NASDAQ bubble. This is insane. After the pandemic, people started talking about all of the people working from home and how all of these commercial office buildings have this very, very low occupancy, and there was going to be this tidal wave of bankruptcies and something in the real estate sector again, but this time commercial real estate, that was going to trigger an economic crisis. Well, it turns out that what you're going to see is that the banks have been doing loan modifications and forbearance and things like that to cover up the fact, and the dam is about to burst right now. Denver now ranks as number 6 nationally for the CMBS office delinquencies at 27.2%, nearly triple the U.S. average. The CBRE, which stands for Coldwell Banker Richard Ellis Group, pegs second quarter downtown Denver vacancy at 36.8%. Let this sink in for a little bit. Commercial real estate is headed for a meltdown on a scale that we have never seen. This is going to be just like the global financial crisis of 2008, with real estate in the biggest bubble in history, bigger than then, plus commercial real estate, plus the stock markets. That didn't happen in 2008. That was residential real estate and mortgage-backed securities and derivatives meltdown. This is a far greater disaster.
Mike Maloney starts with the hard data. In Denver, downtown vacancy rates have exploded to nearly 37%, while delinquencies on commercial mortgage-backed securities have soared past 27%, almost triple the national average. For more than 2 years, banks have extended and modified loans to disguise these losses, but the numbers can no longer be hidden. Over $900 billion in commercial real estate debt will mature in the next 24 months, most tied to properties that have lost 25 to 40% of their value. Refinancing at today's multi-decade high interest rates is impossible without admitting insolvency. Maloney warns that once defaults accelerate, the contagion will spread through regional banks, credit markets, and pension funds, triggering a chain reaction eerily similar to 2008, only larger. He backs it up with everyday data. Freight volumes are down nearly 9% year over year. Building permits have been collapsing since late 2021. Late rent payments are spiking nationwide. Used car sales and prices are plunging. Meanwhile, Wall Street keeps cheering record stock prices, completely disconnected from economic reality. Maloney says this illusion of strength always appears right before the break. Then Peter Schiff connects the dots globally. Gold is up roughly 56% year-to-date. Silver has broken its 1980 nominal peak, and both metals are surging because investors no longer trust paper assets. Schiff calls this the early stage of a generational revaluation, just like the 1970s when gold skyrocketed from $35 to $850 an ounce as inflation and debt destroyed confidence in fiat money. Today, central banks from China to Turkey are dumping U.S. treasuries and buying gold. The dollar's privilege as the world's reserve currency is eroding, and Schiff warns that once that confidence is gone, Americans will face exploding prices, soaring interest rates, and a currency crisis that makes 2008 look small. Even major institutions are waking up. Morgan Stanley recently proposed a 60-20-20 portfolio, allocating 20% to gold. Schiff highlights miners like Pan American Silver and Agnico Eagle, whose earnings are exploding while Wall Street still labels them undervalued. And the latest 2025 data confirms it all. Gold just hit $4,100 per ounce, driven by Fed rate cut bets and record central bank demand. Silver surged past $50, with London liquidity at record lows. HSBC raised its 2025 silver forecast to $38.56, citing global shortages. The World Gold Council reports 77% of central banks plan to keep adding gold reserves this year. These aren't predictions anymore. They're happening right now.
This is an all-time record high for silver. It's eclipsed the peak from 1980. Now, not adjusted for inflation, but just the nominal price is now higher than at any point. And in fact, gold year-to-date is up 56%. Silver's up more than that, but gold's up 56%. That is the biggest one-year gain since the 1970s. And we still have 2.5 months left. But when gold started to move like this in the 1970s, it was the beginning of a huge move. Gold went from $35 an ounce when we began the decade to $850 when we ended it. So I think this is the beginning of a much bigger move in both gold and silver. And, first of all, what it tells you about the stock market, the U.S. stock market's really been in a bear market for 26 years, because in 1999, the Dow was worth 45 ounces of gold at its peak. It's now worth barely 11. So that's a 75% decline in the real value of U.S. stocks measured in real money. But I think what we're seeing now is a warning sign, similar to the warning that we got in 2006 when subprime blew up. That was warning about the financial crisis that hit the following year. I think what we may see next year is a U.S. dollar and sovereign debt crisis. The world is divesting of U.S. dollars. Central banks are unloading dollars in treasuries, and they're buying gold. And I think this means the U.S.'s ride on the global gravy train is coming to an end, because we base our whole standard of living on the dollar's reserve status. We use that to consume more than we produce and to borrow more than we save. And when the world doesn't want our dollars anymore, we're not going to get their goods. They're not going to loan us money by buying our bonds and our mortgage-backed securities. So Americans are going to be looking at much, much higher consumer prices, much higher interest rates. And this sovereign debt and currency crisis will make the 2008 financial crisis look like a Sunday school picnic. You don't have to buy a whole ounce of gold. You can invest whatever you want. You can buy gold ETFs. You can buy fractions of an ounce. And silver, people can buy silver $52 an ounce. You can buy plenty of ounces of silver. We sell silver and gold at Schiff Gold. But I really like the mining stocks. Pan American Silver is probably the highest quality of the silver miners. It's not up as much year to date as like a Coeur d'Alene or a Hecla. But if you look at a longer term chart, Pan American didn't go down nearly as much as those stocks did. So it didn't have that lost ground to make up. But it's a great quality name if you're just going to buy one and you want less downside risk. Agnico Eagle also hasn't done as well as some of the lower quality miners in the last few months. But zoom out, it's been a phenomenal stock. Okay. AEM right now is $171 a share. I've owned it for 20 years. I bought my first shares below $10 a piece. So it's been a huge winner in the gold space when a lot of other gold mining companies were having a lot of difficulty. But pretty much now you could just throw a dart. I don't see how you don't make money buying any gold stock or silver stock. I think the whole group is ridiculously cheap, and the earnings are exploding. There's no other sector of the market that has the earnings growth that gold and silver companies have. And Wall Street has completely missed the boat so far. They haven't been invested. In fact, a year and a half ago, they were putting sell signals out on the mining companies because when gold was at 2,000, they thought it was the top. They said that there's no upside in gold. Well, it's more than doubled since then, and Wall Street still hasn't really embraced these names. Now, I'm just starting to see, for the first time, I've been in the financial industry for 35 years. This is the first year that I've seen any firms, like Morgan Stanley came out and said maybe the 60-40 portfolio should be 60-20-20 with 20% gold.
Right,
so
right.
I think investors are just starting to buy.
So here's the question every investor should ask. When the next wave of defaults hits and the dollar begins to lose its global dominance, will your wealth still be trapped in paper promises or protected by real assets? Mike Maloney warns that the illusion of stability is ending. Peter Schiff says gold and silver aren't speculative trades. They're lifeboats in a collapsing financial ocean. The institutions that mocked precious metals a year ago are now quietly loading up. The smart money is already moving. Now, don't wait for the headlines to confirm it. By the time they do, it'll be too late. If you value truth over narrative, hit like, subscribe, and share this video. Join our growing community of investors who refuse to be blindsided again. Because history doesn't reward those who react, it rewards those who prepare. So tell me, when the system resets, will you still trust the banks or will you trust real money?